One Canadian blue-chip stock gained 84% in the first 7 months of 2026. The next 3 places went to Suncor, Imperial Oil, and Canadian Natural. Oil had taken over the top of the TSX 60. But one company still broke clear of the pack. For clarity, figures in this video are rounded, and currency amounts are in Canadian dollars unless specified otherwise. At number 10, Magna International gained 33%. And on the final day of July, it reported record second quarter profit per share, strong cash generation, and a higher outlook for 2026. At number 9, Power Corporation rose 34%, while its adjusted asset value per share increased 32% through June, and it returned $1.5 billion to shareholders in the first half. At number 8, Pembina Pipeline climbed 34%. During the period, it raised its 2026 core profit forecast as stronger commodity prices helped its marketing business, then approved the 932-megawatt Green Light power project for a major data center. At number 7, CIBC advanced 35% and agreed to sell its Caribbean stake for about $2 billion, although Reuters reported a 5% one-day fall after its second quarter results. At number 6, Sun Life Financial gained 38%. Its June quarter underlying profit increased 11% compared with last year, and July's Bell Partners purchase expanded its United States apartment investment business. At number 5, Bank of Montreal rose 44%, with second quarter underlying profit increasing to about $3 billion from about $2 billion, while its quarterly dividend reached $1.71 per share. At number 4, Canadian Natural climbed 46%, while first quarter production increased 4%, or about 61,000 barrels of oil equivalent per day compared with last year. At number 3, Imperial Oil gained 55%, and in June it won approval for a share buyback program covering up to 5% of its outstanding shares. At number 2, Suncor Energy surged 57%, while first quarter refining throughput reached a record 498,000 barrels per day, and Brent crude stayed above $100 a barrel for much of March, April, and May. And at number 1, the mystery stock is Cenovus Energy, up 84% in the first 7 months of 2026. On July 29th, Reuters reported that higher oil prices and record oil sands output lifted second quarter profit and sent the company's shares listed in the United States up almost 5% by midday. The same report said the Iran war had tightened fuel supply, raised oil prices, and boosted Cenovus earnings from both production and refining. The company's own first quarter figures add depth to that picture. Upstream operating profit climbed to $3.7 billion from $2.6 billion, as benchmark oil prices and production increased. Total upstream production reached a record 972,100 barrels of oil equivalent per day, 6% above the previous quarter. Cenovus also entered the year with a bigger oil sands footprint after buying MEG Energy in November. In February, it said integration and initial cost-saving work had made material progress, while Christina Lake output was higher because of the acquisition. Full 84% rise appears to reflect this combination: an oil price shock, record production, and a larger operating base, with the clearest direct proof arriving in July. On the other side of the leaderboard, WSP Global fell 31%. 5i Research pointed to share dilution, worries about artificial intelligence, lower analyst targets, its earlier expensive valuation, and high debt. Official first quarter results showed leverage at more than 2 times, above management's target range, mainly because WSP borrowed to finance the TRC acquisition. Canada's 2026 leaderboard has been a story of oil strength at the top, but also strong gains in banks, insurers, and infrastructure. Across the TSX 60, 34 stocks rose and 26 fell, while the average gain was 11%. Like the video, subscribe to Global Market Series, and tell us, can Canada's oil leaders keep running if crude prices cool? Thanks for watching, and see you in the next video.